If you're a Canadian with mutual funds at your bank, there's a fee coming out of your money every single year. And you have never once watched it leave. No line on your statement, no withdrawal alert, no receipt. It's called the MER. And mutual fund fees in Canada are among the highest in the developed world. In the branch channel, the funds banks actually sell you, the median equity fund charges about 2.2% of everything you hold every single year. That's not a fee on your gains, it's a fee on the whole pile. Up market, down market, market taking a personal day, the fee never misses. So here's the plan, what this fee actually is, how a branch gets it into your account, the courtroom wave, now unwinding the model, and because fairness matters, what the banks still honestly do better. And at the very end, a 2-minute check that tells you the exact number you're paying right now. People who run it tend to make a face. Quick credibility note before we start. I paid this fee for years, walked into my bank in my 20s, said I'd like to start investing, and walked out owning funds I couldn't name at prices I couldn't see. So this isn't a lecture from a mountaintop. This is a guy pointing at the hole in his own tire. Let's go. MER stands for Management Expense Ratio, one annual percentage that bundles the fund's management fee, administrative costs, trading costs, and taxes. And here's the design choice that makes it invisible. It's deducted inside the fund before your return is ever calculated. You never pay a bill. The money simply never arrives. If you've ever thought my bank advisor is free, this is why. You're not paying. You're paying invisibly, which is the most expensive way to pay for anything. Imagine a roommate who takes rent straight out of your wallet while you sleep, always the exact amount. Never a note, technically disclosed, buried in a document you initialed back in 2011. Across Canada, the median equity mutual fund charges about 1.8% MER. Balanced funds, the classic branch starter kit, run about 1.9%. Even bond funds, the sleepy ones, charge a median about 0.9% for holding bonds, which mostly involves continuing to hold bonds. How does that stack up globally? Morningstar runs a worldwide study of what investors actually experience, fees, disclosure, the works, and grades every market. Canada's grade on fees and expenses below average. And on the balanced fund fee comparison, Canada finishes dead last. Behind every single market in the study. We lead the world in hockey, insulin, and apologizing to furniture we bump into. Also, apparently, in charging ourselves to invest. One of these is not a point of national pride. Now let's turn the percentage into money, because percent is exactly the costume this fee wears to stay invisible. Nobody's scared of a number with a dot in it. Take a $10,000 portfolio at the branch channel median of about 2.2%. The fund quietly keeps about $220 of it. This year, next year, and the one after got 10 times that invested. It's 10 times the fee. The MER scales perfectly with your savings. It's the hardest working thing in your portfolio, and it works for them. And you pay it in losing years too. When your fund drops, the fee still clears. It is the only participant in your account with a guaranteed positive return. For scale, that's a winter of hydro bills or one truly ambitious LCBO receipt. Leaving your savings every year for a product you didn't even know you owned. That's the first promise kept. The invisible fee, now visible. If you want honest Canadian money math like this every week, subscribe. That's the whole pitch. Back to work. Next question. How does a fund like that get into your account in the first place? Nobody wakes up craving a high fee balanced fund. There's a playbook. I've been through it. My version, I walked into my branch, said the magic words, "I'd like to start investing." And the advisor smiled like I just announced an engagement. A risk questionnaire, a few clicks. This balanced fund suits your profile. Sign here, initial there. I left feeling like a responsible adult. I had just bought the most expensive product in the building. At no point Did anyone say what it cost in dollars? The fee lived inside a percentage, inside a pamphlet, inside a folder I filed under Adulthood Complete. And let me be fair, the person across the desk was genuinely lovely. That's the point. The human is nice. The structure behind the human is not. Here's the structure. In Canada, about 70% of retail fund assets are sold through commission-based advice. 2/3 of the entire national pile moving through that exact desk. Commission-based means a slice of your MER flows back to the dealer every single year you hold the fund. It has a name, the trailing commission, the fee that follows you around, which means the branch doesn't get paid when your fund performs. It gets paid when you stay, ideally forever. Your inertia is the actual product. The trailing commission is pitched as paying for ongoing advice. Hold that phrase, ongoing advice, because it's about to do a lot of heavy lifting in a courtroom. It also explains the shelf. A branch advisor mostly offers the bank's own funds. You asked for investing advice, you received a store. Now watch what the sales channel does to price. Equity funds sold on commission, median about 2.2%, fee-based advice, where you pay the advisor directly and transparently, median about 1.1%. Same country, same markets, roughly double the fee, and the only difference is how the salesperson gets paid. The math is not close. On our $10,000 example, that channel gap alone is about $120 a year, not for a better fund, for a different compensation scheme. That's the napkin math I wish someone had drawn for me at that desk. Instead, I got a free pen with the bank's logo on it. I still own the pen. It cost me 4 figures. But here's the part that actually changed how I see this whole industry. It stopped being me grumbling about a pen. The courts got involved. Remember the trailing commission, the ongoing fee for advice baked into the MER. For years, some funds paid it to discount brokers, do-it-yourself platforms. Sit with that. Discount brokers are not allowed to give advice. So investors paid an ongoing advice fee through a channel that legally could not provide advice. Class action lawyers noticed the same sentence you just heard. What followed is quietly one of the biggest fee reckonings in Canadian investing. TD Asset Management settled a trailing commissions class action for about $70 million. Court approved in December 2024. That's a settled fact, not an allegation. CIBC settled a similar case for about $30 million, approved in November 2025. That one covers fund holders at discount brokers. CIBC also has a separate settlement for a different group of holders, different case, different paperwork. Don't mix them up. So let's just say about 40 million settlement has been proposed. And I need to be surgical here, proposed, not approved. A court hearing decides that. Until then, nothing is final. Legal housekeeping, because it matters. Settlements like these typically come with no admission of wrongdoing. Companies settle for many reasons. These are resolutions, not verdicts. Beyond those 3, several other major fund companies face certified class actions alleging similar practices. The companies deny it and are contesting in court. Allegations are not findings. Words matter in this chapter. Even counting only the approved and proposed amounts, TD's is the largest. And together the 3 add up to a 9-figure reckoning over a fee most Canadians have never heard of. Regulators have since moved too. Canada has banned paying trailing commissions to order execution-only platforms. The specific arrangement at the heart of these cases is being shut off at the tap. Now, if you're wondering, am I owed money? I am not going to answer that, and you should side-eye anyone on the internet who does. Each settlement has an official administrator with eligibility rules published. Search the settlement's name, find the official administrator's site, read it yourself. Directions, not legal advice. Status check, because we're near halfway. That 2-minute fee check from the top of the video is still coming. It's how you find out whether you're a character in this story. So if the Branch is a machine for collecting about 2.2%. What's the way out? Mine was embarrassingly simple. It just took me years of paying full price to find it. I moved to Wealthsimple and started buying low-cost index ETFs myself. Self-directed, no advisor, no shelf, and no trailing commission following me around like a golden retriever holding an invoice. An index ETF just buys the whole market and sits there. No star manager, no glossy pamphlet, which is exactly why the fee is a small fraction of a percent. Boring is the discount. My first self-directed buy took about 10 minutes, and 8 of those were me rereading the screen waiting for the catch. There was no catch. There was barely even a screen. The setup looks like this. Open the app, pick a self-directed account, TFSA, RRSP, whatever fits your life, and congratulations, you're the portfolio manager now. That sentence is both the pitch and the warning. Then you pull up an index ETF, and, culture shock, the fee is printed right on the screen in the open, like a number that isn't ashamed of itself. The first time I saw a fund fee displayed voluntarily, I genuinely checked whether I was on the right app. A decade of branch funds trains you to expect fees behind a curtain. The platform's model is commission-free trading on the buys and sells, and the ETF's own fee stays that tiny fraction of a percent. There is simply no about 2.2% anywhere in the pipeline for anyone to collect. I set up a small automatic deposit that buys the same boring index fund every month, and my investing routine is now roughly as exciting as brushing my teeth. That's the goal. Full disclosure. Said plainly, there's a Wealthsimple referral link in the description, and I get a bonus if you use it. That's my relationship with them. Now, you know exactly what I know, and that disclosure is precisely why the next chapter exists. A video that praises an app it links to owes you the honest downsides of the app, not just of the banks. Second promise kept. You've now seen the branch model and the exit. So if you're a Canadian who's done funding a fee machine that was never built for you, subscribe. This channel is the ongoing audit. Second and last, ask of the video, because here's what actually changed for me. The fee stopped being whether and became a decision. Weather just happens to you. Decisions you get to make. Now, the chapter my thumbnail hates and my conscience insists on, what the banks still genuinely do better, and where the fintechs honestly fall short. Banks have humans in buildings. When life gets complicated, an estate, a business sale, a divorce, a retirement drawdown, a good planner across a real desk is worth real money. Banks bundle mortgage, checking, credit card, investments, one login, one branch, one phone number your parents have memorized. Convenience is a real product, even when it's overpriced. And when markets fall apart, some people need a human voice saying, do not sell. If that voice stops one panic sell in a lifetime, it may genuinely have paid for itself. Fee-based advice, the about 1.1% channel, can be a fair deal if you're getting actual planning, tax, estate, behavior coaching. The scandal was never advice costing money. It was paying double for a handshake and a pamphlet. Now, the fintech side of the ledger, because it absolutely has one, self-directed means self. Nobody builds your portfolio, nobody rebalances your mistakes, and at 2 a.m. during a crash, the app will cheerfully let you sell everything you own. True story. In my early do-it-yourself days, I left a quarter of my portfolio sitting in cash for 2 years. No advisor called to say, buddy, what are we doing? Because there was no advisor. That one's fully on me. Support is chat windows and phone queues, not a branch on your corner. These are younger companies, and a slick app that makes buying easy also makes fiddling easy. Boredom is a skill now. So the honest scorecard, complex life, real advice, pay for it transparently, fee-based, simple goal, market exposure, a do-it-yourself for a fraction of a percent, and the math is not close. What almost nobody needs is the thing 2/3 of Canadian fund assets are actually sitting in. Maximum fee, minimum service, sold on a smile and a free pen. All right. The payoff from minute one, the 2-minute check. You need your latest statement and a search engine. That's the entire toolkit. Step one, find your fund's exact name on the statement. Series letter included. That little Series A after the name is very often where the priciest version lives. Step two, search the fund's name plus the words fund facts. It's a short, plain language disclosure document every Canadian fund is required to publish. Regulators built it. It's genuinely good. Nobody reads it. Step three, find the line that says MER. It's printed in bold in a public document that has been sitting there the entire time you've owned the fund. While you're in there, glance one line down. Some funds also charge a separate trading expense line on top of the MER. The MER wasn't even the whole story. Of course it wasn't. Step four, make it money. Multiply your balance by that MER. At the branch median of about 2.2%, every $10,000 costs about $220 a year. Run your own number and sit with it a moment. That's the whole check. 2 minutes, one document, one multiplication. This fee only ever had power while it was invisible, and it just stopped being invisible. My verdict as the guy who paid it 4 years, nobody is coming to fix this for you. The banks won't volunteer. The courts move in decades. The document sits there unread. But you can end your own chapter of it in one afternoon. I did. Highest paying afternoon of my life. And I once helped a friend move a piano. One heads up. If your advisor suddenly calls after you start moving money, take the call. That call is the trailing commission explaining itself in real time. Now confess in the comments, run the check and drop your MER below. Over or under that branch median we saw. I want to see how bad it gets. And when you're ready for the Fix It Forever version, my couch potato index investing video is on screen right now. The whole low fee portfolio start to finish. I read fee tables so you don't have to. And formally, for the lawyers, this was education, not financial advice, and definitely not legal advice.